Welcome to this explainer. Right now, we're putting a magnifying glass on a financial event that's got the entire market buzzing. I'm talking, of course, about the rumored SpaceX IPO. Look, the hype is absolutely deafening, and honestly, for good reason. But we aren't here to just read the headlines. We want to know exactly what's going on under the hood. Okay, let's dive into this. I'm sure you're seeing quotes exactly like this one flooding your feeds lately. People aren't just calling this the opportunity of the decade. They're literally calling it the greatest investment opportunity of our lifetime. And man, it's so easy to feel that FOMO, isn't it? We're talking about a company with this awe-inspiring vision of making humans a multiplanetary species. Throw in their recent ambitions to unlock a massive $26 trillion AI market, and you've got a story that is genuinely one of the most remarkable things in modern business history. And here's the thing. It's not just some sci-fi pipe dream. It's backed by functional, undeniable reality. Get this, SpaceX is currently responsible for roughly 80% of all the mass lifted into orbit every single year. Just let that sink in for a second. 80% of everything going into space across the entire globe comes from this one single company. That is an absolute stranglehold on orbital delivery. And this brilliantly illustrates how they achieved that absolute dominance. The achievements here are staggering. I mean, the Falcon 9 isn't just a cool piece of tech, it's the most flown rocket in history. In 2024 alone, they launched 134 times. That's a rocket heading to space more than once every 3 days. And then you have Starlink, their satellite internet business. It's sitting at over 10 million subscribers globally and operating with a legitimately impressive 36.5% profit margin. So Starlink alone is raking in billions in real profitable revenue. It all sounds absolutely perfect, right? It kind of makes you want to buy in right this second. Actually, scratch that. It makes you want to go all in. But then, I actually read the 270-page S1 filing. For those who might not know, this is the mandatory legal document a company has to file with the government before going public. And in this document, once you get past all the beautiful photos of rockets and those inspiring mission statements, the company's lawyers actually have to tell you the unvarnished financial truth. And what's hidden in those pages completely changes the complexion of this entire IPO. Which brings us to part 1, the hidden AI cash burn and deconstructing the XAI merger. So earlier this year, SpaceX merged with Elon Musk's XAI, meaning you aren't just buying a rocket company anymore. You're buying an AI conglomerate with these wild dreams of orbital data centers powered by the sun and cooled by the vacuum of space. Sounds amazing, but look at this staggering contrast on the balance sheet. In just the first 3 months of the year, the AI division spent $7.7 billion on hardware and infrastructure. But in that exact same quarter, the AI business only brought in $818 million in revenue. They're literally spending $7.7 billion to make just over $800 million. A big part of that pressure is because their AI chatbot, Grok, is really struggling to win market share. In fact, SpaceX is actually having to lease data center space to Anthropic, the makers of a rival AI called Claude, just to help offset some of these massive infrastructure costs. When you zoom out, you see that the pace of these losses is accelerating violently. Look at the full year of 2023. SpaceX lost $5 billion. But then look at Q1 2024. They lost $4.3 billion in just 3 months. Over the last 4 quarters combined, SpaceX has burned through an eye-watering $30 billion in cash. Now, losing money to grow isn't inherently a bad thing, but the sheer colossal scale of this cash burn, which is largely driven by that new AI division, is something every potential investor absolutely needs to understand. Moving on to layer number 2, governance and the Mars priority. Let's look at where the money is really going. Now, what's really interesting about this slide is that while Starlink is highly profitable, those multi-billion-dollar profits aren't exactly flowing to retail shareholders. They are explicitly being funneled toward the ultimate goal of colonizing Mars. And notice how that priority is legally enforced. SpaceX has 2 classes of stock. You've got Class A shares, which the public buys, and Class B super voting shares. Well, Elon Musk controls 93.6% of those Class B shares. When you crunch the numbers, he commands 85% of the total shareholder vote. He essentially has absolute authority. Literally, the only way Elon Musk could be fired as CEO is if he voted to fire himself. Because of this, the S1 filing explicitly defines SpaceX as a, quote, controlled company. Basically, this regulatory status means public Class A shareholders will have virtually zero say in how the company's run or how its money is spent. And this unchecked control allows for some cross-company spending that might make traditional investors, a bit nervous. Just as an example, SpaceX casually bought $131 million worth of Cybertrucks at full retail price and spent another $700 million on Tesla batteries.
That's a massive amount of cross-company spending, and it gives Wall Street serious heartburn, especially with internal discussions floating around about potentially merging SpaceX and Tesla permanently down the road. To ground this whole narrative in reality, we have to look at the literal warnings written by SpaceX's own lawyers in the S1. They state plainly, many of our initiatives involve significant technical complexity, unproven technologies, or technologies that do not exist. That right there proves there is a massive, highly costly gap between their sci-fi vision of orbital data centers and lunar economies and their actual day-to-day operations. Someone is going to have to pay to invent technologies that literally do not exist yet. So the crucial point is Section 3, the valuation reality check. Let's look at the math behind this $1.75 trillion IPO. At a $1.75 trillion valuation, and with roughly $20 billion in revenue over the last 4 quarters, you are being asked to pay 90 times sales. Let's compare that directly to Google, right? A highly profitable, incredibly dominant market giant. Google currently trades at about 11 times sales. With SpaceX, for every single dollar of revenue, and we're talking revenue here, not profit, you're paying $90. You are essentially paying today for future potential as if it has already been perfectly achieved. That is one massive premium. And there's a really harsh operational reality tied to that valuation. See, SpaceX is expecting to raise about $75 billion in this IPO. But remember that $30 billion annual cash burn rate we talked about just a minute ago? Well, if they don't tighten up their spending, and let's be real, they've actually been increasing it, that massive $75 billion war chest is going to be completely depleted in just 2.5 years. After that, they're likely going to need to raise even more money. This leads us to a broader concept every investor really needs to grasp: the IPO trap and the mechanics of the road tour. Let's look at how Wall Street acts as a salesperson and how you can avoid becoming their exit liquidity. Whenever a company goes public, the investment banks managing the whole process hype this stock up to massive institutional investors. Those guys buy in cheap before it ever hits the public market. And you really have to watch out for the lockup expiration. See, early insiders are legally barred from selling their shares for a set period, which is standardly 180 days. Once that period ends, a flood of shares usually hits the market, historically causing the stock price to drop. Now, specifically for SpaceX, Elon Musk has committed to a 366-day lockup. But as an investor, you've got to be acutely aware of these timelines because they act like predictable gravity on a stock's price. Let's move to and see how this builds into Part 5, investing versus speculating. Let's separate price from value. This is really how we transition from emotional FOMO to disciplined wealth building. As the famous saying goes, price is what you pay, value is what you get. The gap between those two numbers, that's your margin of safety. A fantastic story, an incredible mission to Mars, brilliant engineering, all of that can still amount to a terrible financial investment if you pay the wrong price for it. Look, it's entirely okay to buy into an IPO out of excitement, but you have to recognize it as a speculative bet, not foundational investing. Your financial foundation should prioritize stability, things like maxing out your 401k and utilizing low-cost index funds, long before making bets on high-priced IPOs. To help you navigate this, here's a highly actionable framework. Number 1, we are investors, not speculators. 2, value is simply the present value of future cash flows. 3, if you don't understand the mechanics of it, just don't buy it. 4, the market votes in the short term, but it weighs profits in the long term. And 5, overpaying for a great story ruins the investment. So as we watch the SpaceX IPO approach, armed with the realities hidden in the S1 filing, the accelerating cash burns, the governance structures, and the massive valuation multiples, I want to leave you with this one vital question to ask yourself. When you look at your portfolio, are you truly investing or are you just speculating? Use this explainer as a tool to navigate the hype and make the mathematically sound decisions that secure your future. Keep learning, stay focused, and I'll see you in the next explainer.